What if I told you that $10,000 invested today could become $100,000 by 2035? Now, before you click away thinking this is another get-rich-quick scheme, hear me out. We're living through the biggest technological transformation since the internet revolution. Artificial intelligence, cloud computing, and digital transformation are creating wealth at a pace we've never seen before. And today, I'm going to show you 5 exchange-traded funds that are positioned right at the center of this revolution. These aren't random picks. These are funds managing over $800 billion combined, with verified track records and exposure to the companies building our future. Real quick, hit like and subscribe because I spent weeks analyzing hundreds of pages of fund data so you can make this decision in the next 10 minutes. Let me be crystal clear about what we're discussing. For an investment to grow 10 times in 10 years, it needs to achieve approximately a 26% compound annual growth rate. That's aggressive, no question about it. But here's what makes this conversation worth your time. 4 of the 5 funds we'll analyze have delivered one-year returns between 23 and 27% as of October 2025. They've proven they can hit these numbers. The question isn't whether it's possible. The question is whether they can sustain it. And after diving deep into hundreds of pages of fund data, analyzing their holdings, understanding their strategies, and studying their track records, I believe these 5 have the best shot at delivering life-changing returns over the next decade. Now, why growth ETFs instead of individual stocks? Here's the brutal truth about stock picking. Most professional fund managers can't beat the market consistently. If the experts struggle, what chance do we have picking the next Nvidia before it explodes? But here's the beautiful thing about these ETFs. They don't require you to predict the future. They're systematically designed to identify and weight companies exhibiting the strongest growth characteristics. They rebalance quarterly or semi-annually, automatically capturing emerging leaders while trimming positions in companies where growth has stalled. You get professional management, instant diversification across dozens or hundreds of companies, and fees so low they're almost criminal. We're talking $4 per year for every $10,000 invested in some cases. Compare that to the typical 1% fee from actively managed mutual funds, and you're saving thousands of dollars over decades. Those savings compound into real wealth. Let's start with our first ETF, the SPDR Portfolio S&P 500 Growth ETF, ticker SPYG. This fund from State Street Global Advisors manages $43 billion and has delivered absolutely crushing performance in 2025. We're talking a year-to-date return of 19.48% and a one-year return of 26.84%, the strongest among all funds we'll discuss today. But here's what makes SPYG special. It combines the quality and stability of S&P 500 companies with concentrated exposure to growth factors. This isn't some speculative fund buying unprofitable startups. These are 216 proven companies that have already achieved S&P 500 status, which means they've demonstrated profitability, liquidity, and business sustainability. The fund's expense ratio is just 0.04%, tying for the absolute lowest in the industry. Now, let's talk about the elephant in the room. SPYG's NVIDIA allocation is 14.38%, the highest among all funds we're analyzing. That's not an accident. NVIDIA dominates AI chip infrastructure, and SPYG's methodology has identified it as exhibiting the strongest growth characteristics in the entire S&P 500 universe. Beyond NVIDIA, the top 10 includes Microsoft at 6.39%, Apple at 5.54%, Broadcom at 5.29%, and Meta at 5%. These aren't just tech companies. They're the companies defining how business operates in the 21st century. The fund allocates 42.56% to information technology, 15.65% to communication services, and 12.5% to communication services, 0.07% to consumer discretionary. What I love about SPYG is its systematic rebalancing. Every 6 months, it rescreens the entire S&P 500 for growth characteristics. Companies that lose momentum get trimmed. Emerging growth stories get added. You're always exposed to current growth leaders, not yesterday's champions. Our second ETF is the legendary Invesco QQQ Trust, simply known as QQQ. With $390 billion in assets and a 26-year track record that spans the dot-com crash, the financial crisis, COVID-19, and every bull market in between, QQQ tracks the NASDAQ 100 index, giving you pure-play exposure to 102 of the largest non-financial companies on the NASDAQ. Here's why this matters. By excluding financial companies, QQQ maintains laser focus on technology, consumer innovation, and healthcare disruption without dilution from traditional banks. The fund has delivered an 18.71% annualized return over 5 years, the highest long-term performance of any fund we're discussing. Its one-year return of 22.94% and year-to-date return of 18.13% demonstrate consistent ability to capture growth momentum. Now, QQQ costs 0.20% annually, which is higher than our cheapest options, but you're paying for something valuable. This is the second most traded ETF in America, with over 40 million shares changing hands daily. That exceptional liquidity means you can buy or sell anytime with bid-ask spreads averaging just 0.01%. For investors dollar-cost averaging with monthly investments, this liquidity eliminates trading friction entirely. QQQ's top holdings tell the story of modern innovation. NVIDIA at 9.62%, Microsoft at 8.28%, Apple at 8%, Broadcom at 6%, and Amazon at 4.98%. The fund allocates 53.3% to information technology and 15.7% to communication services, creating the purest technology exposure of any fund we'll discuss. What's unique about QQQ is its quarterly rebalancing and annual reconstitution. This dynamic methodology has allowed the fund to evolve from a PC-era portfolio in the late 90s to an Internet-era portfolio in the 2000s to today's cloud and AI-era portfolio, all without requiring manual intervention from investors. Now let's discuss Vanguard Growth ETF, ticker VUG, the gold standard in low-cost growth investing. Vanguard manages $195 billion in this fund with an expense ratio of just 0.04%. For context, Vanguard operates under a unique corporate structure where the funds own the management company, meaning all profits return to shareholders rather than outside investors. This alignment creates permanent competitive advantages in cost efficiency. VUG has delivered a 23.96% one-year return and 15.8% year-to-date return, with a 5-year annualized return of 16.37%. The fund holds 168 carefully selected companies with approximately 61% of assets concentrated in the top 10 holdings. NVIDIA commands 12.3%, Microsoft 11.5%, and Apple 10.54%. Together, these three mega-cap leaders represent over 34% of the fund, providing concentrated exposure to the companies best positioned for AI adoption and digital transformation. VUG allocates 52.09% to information technology, a deliberate overweight that captures the sector's superior earnings growth trajectory. What sets VUG apart is its incredibly low portfolio turnover of approximately 11% annually. This tax efficiency minimizes capital gains distributions that erode after tax returns, making VUG particularly suitable for taxable brokerage accounts. Combined with Vanguard's reputation for shareholder-first culture and operational excellence, VUG represents the perfect core holding for long-term wealth builders who want maximum growth exposure with minimal costs and maximum tax efficiency. Our fourth fund is the iShares Russell 1000 Growth ETF, ticker IWF, from BlackRock, the world's largest asset manager. IWF manages $120 billion and provides the broadest diversification of any fund we're discussing, with 395 holdings spanning large-cap and mid-cap growth companies. This broader scope means IWF captures emerging growth stories earlier than funds restricted to only the largest companies. The fund has delivered exceptional performance with a 25.3% one-year return, 17.08% year-to-date return, and 17.38% 5-year annualized return. IWF's expense ratio of 0.18% reflects the value of BlackRock's institutional research capabilities and operational scale. The fund offers a dividend yield of 0.64%, the highest among all funds analyzed, providing modest income for investors who want some cash flow alongside growth. IWF's top holdings include NVIDIA at 12.89%, the highest allocation of any fund we're discussing, positioning shareholders for maximum AI infrastructure exposure. Microsoft weighs in at 11.47% and Apple at 11.1%, ensuring substantial exposure to the world's two most valuable companies. The fund allocates 55.3% to information technology, the highest sector concentration we'll see today, and 14% to communication services. What makes IWF compelling for the 10x scenario is its 395 holding portfolio. While mega-cap tech leaders drive near-term returns, IWF's mid-cap exposure provides options on tomorrow's market leaders. Companies that become the next NVIDIA or Tesla get captured as they grow into prominence, systematically refreshing the portfolio with emerging champions. Our fifth and final fund is the Schwab U.S. Large Cap Growth ETF, ticker SCHG. Schwab manages $50 billion in this fund, tracking the Dow Jones U.S. Large Cap Growth Total Stock Market Index. SCHG has delivered a 23% one-year return, 14.8% year-to-date return, and 17.8% five-year annualized return. The fund's expense ratio matches the industry low at 0.04%, ensuring maximum return retention for shareholders. SCHG holds 197 companies with top 10 concentration of 58.48%, striking a middle ground between aggressive concentration and prudent diversification. What distinguishes SCHG is its balanced approach to position sizing. NVIDIA represents 11.3%, Microsoft 9.7%, and Apple 9.4%. No single holding exceeds 12% of assets, providing meaningful exposure to growth leaders while implementing thoughtful risk management. This moderation appeals to conservative growth investors who want technology exposure without excessive single-stock concentration. SCHG allocates 52% to information technology, 14% to communication services, and 13.5% to consumer discretionary. The Dow Jones methodology emphasizes quality screens alongside growth metrics, focusing on companies with strong revenue growth, earnings growth, and return on equity. This quality focus provides more downside protection during corrections while capturing upside during bull markets. The fund's quarterly rebalancing ensures continuous exposure to current growth leaders rather than historical champions. Now let's get strategic about which fund might be right for you. If you're between 20 and 40 years old with a long time horizon and high risk tolerance, you can afford to be aggressive. Consider allocating 70 to 90% of your equity portfolio to growth ETFs. SPYG makes an excellent core holding with its ultra-low fees and strong momentum, while QQQ serves perfectly as a 20 to 30% satellite position for concentrated technology exposure. If you're between 40 and 60, balancing growth objectives with increasing risk awareness, consider 40 to 60% growth ETF allocation. VUG represents the ideal core holding with its balance of growth exposure, rock-bottom costs, and moderate concentration. Pair VUG with dividend-focused or value-oriented holdings for more balanced equity exposure. If you're over 60 and approaching retirement, limit growth ETF allocations to 20 to 30% of equity holdings. SCHG's balanced approach with no position exceeding 12% provides growth participation with built-in risk management. Let me give you the reality check you need to hear. Achieving 10 times returns requires sustained 26% annual growth. That's aggressive and assumes everything goes right. Technology concentration ranging from 42 to 55% across these funds creates vulnerability to sector-specific downturns. The 2022 correction saw the Nasdaq 100 decline 33% peak to trough, demonstrating how quickly growth valuations compress when interest rates rise. You must be prepared for 20 to 40% drawdowns and have the conviction to maintain positions through volatility. Rising interest rates disproportionately impact growth stocks by reducing the present value of distant future earnings. Regulatory scrutiny of major technology platforms creates ongoing uncertainty. U.S.-China technology competition introduces geopolitical risks. These aren't theoretical concerns. They're real risks that could derail the 10 times scenario. But here's why I'm ultimately bullish on these 5 funds. First, we're still in the early innings of AI adoption. Goldman Sachs estimates the AI infrastructure build-out represents a $1 trillion investment opportunity by 2030. McKinsey estimates generative AI could create $4.4 trillion in annual economic value. These aren't incremental improvements. This is foundational technology reshaping how every business operates. Second, cloud computing penetration remains below 30% of total IT spending, suggesting substantial runway for continued migration. Third, these funds' systematic rebalancing captures emerging growth stories while trimming mature positions, ensuring continuous exposure to innovation leaders. Fourth, ultra-low expense ratios mean 99.96% of gross returns compound for shareholders rather than being consumed by fees. Over decades, this cost advantage adds multiple percentage points to final wealth. Here's your action plan. Research these 5 funds on their official websites. Consider starting with small monthly investments through dollar cost averaging, which exploits volatility by accumulating more shares during corrections. Don't invest money you'll need within 5 years. Growth investing requires time to work through inevitable volatility. The wealth-building opportunity of the next decade belongs to those who position themselves today. These 5 ETFs offer professionally managed, diversified, cost-efficient access to the companies building tomorrow. Your financial future starts with the decisions you make right now. If this video helped clarify growth investing, smash that like button, subscribe for more deep dives, and drop a comment telling me which ETF interests you most. Let's build wealth together. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.